Hello, my name is Jason Laurie, Chief Investment Officer here at Altair Advisors. I want to welcome you to our mid-year summer webinar. I'll begin today with a market and economic overview, and then I'll hand it over to my colleague David Lin, Altair's Head of Investment Research, for a question and answer session with his guest, Joe Dennison from Zevenbergen Capital Management. I'm going to use my time today to talk about what I think are the 5 takeaways here at mid-year. And then I'll spend the rest of my time kind of going through each of the 5 points. So the first is to recap the 5 points. Stocks and bonds both had their worst first half in decades. And one of the keys to that sentence is the and, stocks and bonds. The reason for the bad performance is mostly related to the high inflation. And it's not just that the inflation was high, it's that it remains sticky. And we saw that this morning with our CPI reading at a little over 9%. Positive developments, though, on inflation is that we're finally seeing some of the supply chain issues improve or ease, and commodity prices have fallen. Fourth takeaway is that the markets and the Fed are now pricing in the same level of interest rate hikes in 2022. So the market and the Fed are now on the same page, or said another way, the market has now fully priced in all the Fed rate hikes. And then finally, the economy is decelerating, but key elements remain solid. So with that, I'll start with the first takeaway, which is performance. And as I mentioned, both stocks and bonds started the year poorly. And in fact, if 630 were a full year, the S&P 500, looking at the post-war period, it would have been the 4th worst year since the post-war period. And if we look at taxable bonds, if we go back to the beginning of the taxable bond index in 1976, it in fact would be the worst year. So both stocks and bonds had bad starts. But it wasn't just the S&P 500 and taxable bonds. If we look at all of the major asset classes, most of the higher risk asset classes have returns through mid-year that were at or above 20% or thereabouts negative returns. Calling out a few of the outliers is one, growth stocks down over 28%. Much more to come on growth stocks in the second half of the webinar with David and his guest Joe. The best, I'll put that in quotes, performer on the higher risk side is the value stocks at almost negative 13%. And then muni bonds outperforming taxable bonds, the last row, at negative 6%. So across the board, a bad start to the year. And if we move from the asset class level down to the sector level, the chart kind of speaks for itself that by a long shot, the only sector that had any kind of return was energy. And we know that energy does well when the price of oil, natural gas, and other commodities rise. Profits go up for that sector. And so what we really saw is all year the price of commodities have risen, but really the kerosene on the fire or the catalyst for the increase, most of the increase, was Russia's invasion of Ukraine. And although more near term, the energy still is the highest, best performing sector, commodities have pulled back, and they really started this pullback in early June. So more on the commodity sell-off in a minute. Turning to inflation, I think as everybody on the webinar is painfully aware, inflation is running at a 40-year high. And again, we saw that this morning with the CPI number, headline number at 9.1%. Why is inflation running high? Really all pandemic related. We had extremely strong consumer demand. We had supply chains that weren't functioning. And then we had very accommodative monetary with the Fed and fiscal policy with Congress. Most would conclude now that it wasn't just accommodative, it was overly accommodative. And you mix all these into the pot and stir it, and that's why we have at least near-term 40-year high inflation. At the beginning, I said there were some positive developments on the inflation front. One of them is that commodity prices have dramatically fallen as of late. As I mentioned, if you look at from January 1st, commodity prices have pretty much been on the rise. But if you look at the right-hand side of the chart, really from early June to yesterday, and we're using copper and crude oil as proxies of commodities, we've seen this dramatic decrease in commodities. So this is yet to play through the system. The other positive development on the inflation front is supply chains. The supply chain bottlenecks were certainly one of the primary causes of the inflation that we're experiencing today. On the left-hand side, this is the Fed surveys from around the country, Philadelphia, Kansas City, and New York, all reporting lower delivery times. And again, those lower delivery times were just starting to be reported. So this is kind of more real-time information. And then the manufacturing backlog. The lower the number, the lower the backlog, and you can see on the right-hand side, the trend is lower. So positive developments, they're going to take time to work through the system. It's not going to certainly bring down inflation overnight, but these are the positive developments that we're certainly looking for, commodities and the supply chain. Turning to the fourth takeaway, which is that the markets and the Fed are now pricing in the same level of interest rates at the end of the year. You can see at the end of the year, the Fed and the market are now pricing in interest rates to end at about 325, 350, and that's the short-term federal funds rate. A lot of times we get the question of, should we do anything in advance of the Fed rate hikes between now and the end of the year? There's 4 Fed meetings left, July, September, November, December. And the reality is the market has already priced all those in. That's really what the chart is suggesting is that if you look at the yields today, it's assuming these rate hikes have already taken place because the market always moves ahead of the actual rate hikes. Last takeaway is on the economy. And as I mentioned, the economy is decelerating, but there are key elements of the economy that are certainly still strong and in fact, very strong. We start at the top, manufacturing and labor, very strong still. The bottom on the negative side, stock prices and consumer and business sentiment are certainly some of the most negative of the signals. Let's look at consumer sentiment because that's probably the most negative. We actually just hit a pandemic low with the June reading. As you can notice that consumers have been reporting bad sentiment for a while. This is not necessarily new news. It's been trending lower. But what's interesting about consumer sentiment is that although the consumer hasn't been feeling good, or at least hasn't been reporting that they're feeling good, they've still been spending. And we actually got a real-time data point this week with Pepsi's earnings. Pepsi reported good earnings. More importantly, though, they were able to push through a 12% price increase, and they spent some time on their call talking about how resilient the consumer is. Now, they did warn that it can't last forever, but the takeaway here is that consumers have been willing to pay higher prices, and even though they're not feeling great, they're still spending. Finally, probably the most positive of the economic data points is still the labor market. Last Friday, we received the June employment rate. It came in at 375,000 jobs added. But more importantly, if we look across the whole first 6 months of the year, the first quarter, we added 1.6 million jobs. The second quarter, we added 1.1 million jobs. So hardly an economic indicator that would be indicating any kind of a recession. In fact, this is one that is still very, very strong. So now I'm going to use my last 2 slides before handing it over to David and Joe to talk about growth stocks. I'm going to use my last 2 slides here to put the current market decline in perspective. So what I've done here is I have looked at all of the post-war bear markets, and there are 10 of them. And then I grouped them by the top section by those bear markets that were accompanied with no recession or a mild recession. That's the top. And then the bottom, those that were accompanied by a severe recession. So the first takeaway is just because you have a bear market, and in this case, we're defining bear market as the S&P falling by 20% or more. Just because you have a bear market doesn't mean that it has a severe recession or a recession at all. That's the top section. The key takeaway to this slide, though, is that unless we're headed for a severe recession, which we do not see, past bear markets suggest that the current decline, and I'm looking at the column that's called price decline from peak to trough, the current decline is much closer to the end than the beginning. Or stated differently, much of the bad news, again, assuming no recession or a mild recession, is already priced into the market because markets move far ahead of the economic data. My last slide has a similar takeaway, but from a different vantage point. Again, looking at the post-war period. This is any time we've had 2 quarters, back-to-back quarters, where the return, the cumulative return, was minus 20% or greater. And what you can see is in the 1 to 4 quarters after those 2 bad quarters, the returns have been very positive, except if you're headed into a severe recession like the 2008 global financial crisis. Certainly not something we see. So with that market recap, I'm going to hand it over to my colleague, David Lin, to discuss growth stocks with his guest, Joe Dennison.
Thanks, Jason. It's great to be here, and thank you all for joining us today. As Jason mentioned, my name is David Lin, and I'm head of Altair's investment research. One of the hallmarks of our due diligence process is to identify active managers that run highly concentrated, high conviction portfolios that in most cases look very different than their benchmarks. Zevenbergen is a Seattle-based manager that specializes in running growth equity strategy, and they really fit that bill. Altair has been recommending Zevenbergen for nearly a decade now, so we wanted to bring in Joe Dennison, a co-portfolio manager on their growth strategies, to discuss their portfolio and markets. Joe, thanks for being with us today.
Great, thank you, David.
So let's jump right in, Joe. Following a phenomenal 4-year stretch through the year 2020 that produced outsized performance, the last 18 months coming out of the pandemic has been a very challenging period for aggressive growth stocks in general, but also for Zevenbergen's growth strategy in particular. Can you spend some time talking about the investment focus of your strategy and why performance turned so dramatically last year? Specifically, how much of the underperformance has been attributable to your style versus, say, company-specific issues in the portfolio?
Sure, it's a good question. Zevenbergen Capital Investments, maybe just to lay the framework a little bit, we are a high conviction, high growth equity manager with a singular focus on building concentrated portfolios of companies who we believe are shaping the future. And in doing so, we place a very strong emphasis on investing alongside founders and management teams who we feel have the vision and ability to drive their companies for the next decade. So really at our core is the philosophy that stock prices follow company fundamentals over time. And we have that sometimes novel opinion that people do still matter. And we really do strive to identify and engage with innovative management teams early and often, and prefer to invest in companies that are founder-led. Founders we have found share our long time horizon and are much more willing to rock the boat over the short term to attack much larger problems. As long-term growth managers, our process and philosophy have always led us to invest in companies and trends that we felt offer superior products or reduce friction for customers in ways that ultimately lead to significantly greater adoption. And so as we entered the pandemic back in 2020, many of those trends and companies that we've been investing in for 5 to 10 years, in some cases, were in areas such as e-commerce and cloud software that saw rapidly accelerating growth, as companies and consumers were really forced to evolve and adapt to living and working in fully remote, fully digital ways. As a whole, the companies in our portfolio saw adoption pulled forward from a few years into a few short months, leading to meaningful outperformance for our strategy, as you called out back in 2020. As we then moved through the pandemic, we started seeing signs of increasing macroeconomic uncertainty. There was a less than peaceful transition of power in Washington. We had back and forth reopenings, new variants popping up, global supply chain challenges, and sales durability concerns for some of those pandemic beneficiaries, all of which leading to swift and severe rotations into securities that were offering higher near-term visibility more exposure to a cyclical recovery, the energy stocks in particular, and then more of a general sense of comfort. I think the macro issues of 2020 are pretty well understood at this point, and Jason did a good job laying that earlier. We're really battling the three I's of inflation, interest rates, and invasion, which have led markets pretty much across the board into what some have called a vortex of pain. So there is an increasing chance of a recession, even if only by definition or small in magnitude, and markets have certainly been behaving accordingly. In these times of heightened uncertainty and risk aversion, our strategy will usually bear an outsized share of that pain because it requires taking a look out into the future, which is not where people want to be when there are so many short-term unknowns. Overall, as you called out, our style has been highly out of favor, and valuations in our space have now been on a downward trajectory for 16 straight months, to the point where we're now well below pre-pandemic levels and at or near the cloud and software resets that we saw back in 2016 and late 2018, which were during similar periods of rising rates and heightened recession concerns. There have certainly been some stock-specific issues, mostly around the pandemic-fueled growth being either mismanaged or unsustainable. But overall, portfolio company fundamentals have been largely consistent and continue tracking close to 30% top-line revenue growth on average. So from our perspective, when we see correlations and bearish sentiment at these all-time highs, it really shows how indiscriminate all the selling has become in the markets. Every discussion and headline that we're seeing right now is focused on macro, which is leaving the fundamentals almost irrelevant. And so when everything's moving together, and in our opinion, it's a great time to be an investor and an opportunity to really upgrade your portfolio and own secular growth companies at a reset valuation. If you can maintain your time horizon and then have an ability to look past these short-term headwinds.
Got it. Thanks for that perspective, Joe. And it sounds like, it's been mostly broad-based rather than company-specific issues, so it relates more to your style. I noticed in your comments that you mentioned kind of e-commerce and cloud. So I think some may say that this sounds very similar to the dot-com bubble that bursted in 2000, when you had a lot of technology-oriented companies with, really high valuations, eventually went out of business. What is different about today versus what we experienced back then?
That's another question we've been getting a lot, and I think it's good for us to call out those key differences that we're seeing as a firm and the strategy that was really founded back in 1987. So we've lived through a lot of the different cycles from a up and downside standpoint. First of all, on the valuations for the NASDAQ as a whole peaked out at close to 200 times earnings back in the dot-com bubble. So even those top 10 largest weights in the index were averaging 75 times earnings. We had companies in Cisco and Oracle alone that were selling at 125 to 130 times earnings. So crazy high valuations. Today, those top companies maxed out closer to 40 times earnings level and are now sitting comfortably in the low 20s, roughly a third of where we were at during the dot-com bubble. I think even more importantly, from a fundamental level, the nature of technology companies today is very different from what it was during the bubble. Most people are pretty familiar with those stereotypical 90s bubble companies, the Webvans and Pets.com that were being valued exclusively on eyeballs and hope, and in some cases didn't even have revenue before coming public. Today's public companies are much more established, have clear business models, and our portfolio in particular has been much more focused on identifying high quality businesses with the ability to continue investing in any market environment. So today, close to 90% of our portfolio companies are free cash flow positive this year. So these are not eyeball, hope, and dream companies, but real durable businesses who are able to continue investing and sustaining their growth while attacking large addressable markets. Even those established late 90s companies were much more capital intensive in nature with very lumpy licensing sales types of models. Today's software business models are much more predictable with highly recurring revenue streams. And more importantly, they're solving real business problems and have established themselves as mission critical solutions. So technology has really shifted from a nice to have or a nice research side project to well-established essential foundational pieces of nearly every company in the world. Solutions like a cybersecurity, cloud storage, or communications are not going to be turned off in a challenging macro environment because they put the entire business at risk.
Got it. So you described several characteristics of companies that you guys look for. Maybe it would be helpful for you to talk about a couple of those names in the portfolio. And so maybe you can highlight some of them, perhaps ones that have experienced significant price drops, peak to trough since 2020.
Sure. I thought it'd be good to highlight two of our lesser known positions in the portfolio. We are all cap managers, as I mentioned, but most people typically associate us with the larger companies that we've held for a long time, the Amazons and Teslas and Shopify's in the portfolio. I think it's important to call out that most new names in our portfolio are coming in the small to mid cap range, with more than 30% of the portfolio having come public just in the last 5 years. So first company I want to talk about real quick is Bill.com. Ticker is Bill. They are a founder-led financial automation software company that really sits at the heart of small businesses' accounts payable and receivable processes by connecting the business to their clients and suppliers through their software integration. Over 90% of small businesses' bills are still being paid by paper check, and Bill's platform ensures those bills and receipts do not get lost in the shuffle, enabling invoicing, approvals, payments, and reconciliation processes to all move through the system in a very highly transparent and automated fashion. Bill makes their money by charging customers a very low $40 to $70 monthly fee to access the platform, and then a small fee on every transaction that they manage. So it's a very small cost to pay for their customers when considering the amount of time and risk that the platform is taking off the table for the businesses. This allows the companies to hire and focus on their own strategic priorities rather than the more manual paper-based processes. From a fundamental level, the company just reported 74% year-over-year organic revenue growth in the first quarter this year. They have roughly 135,000 customers for its platform and processed more than 10 million transactions in the quarter, representing over $55 billion in total payment volume. Despite that success and impressive growth, stock's down nearly 50% just year to date alone due to the broader market sentiment we talked about. But we still estimate the company is only 5% penetrated in their overall market opportunity and has in clear path to potentially more than double over the next 5 years. Next company, also a little different and lesser known, is Sprout Social. Ticker is SPT. They're another founder-led company, but operating in the social media space. They're a social media management platform company. So social media, we all know, has spread to the point where it reaches half of the world's population, really influencing buying behaviors and changing the way the world communicates. But social media has become far more than just a place for businesses to advertise and has really evolved to impact all aspects of marketing, public relations, sales, customer service, business intelligence, and strategy. The problem with that is along that journey, businesses have ended up with very fragmented marketing and engagement channels. They're very difficult to manage and almost impossible to optimize from a holistic point of view. It's not unusual today for a business to have more than a dozen social media profiles that they need to constantly monitor and manage. So Sprout's platform offers a very powerful, easy to use solution that enables customers to manage those complexities across social media channels, and has really built close relationships with all those social media platforms and has strong integrations with the likes of Microsoft, Salesforce, and HubSpot, so customers can not only manage those social media data, but seamlessly integrate it alongside all their other customer management and analytics tools. Today, more than 30,000 customers ranging from local restaurants all the way up to enterprise customers like Shopify, Uber, and Lowe's are using Sprout Social's platform to connect and manage all of their social strategies and communications from one centralized location, while Sprout continues to explore new and innovative solutions to offer to its customers. From a fundamental standpoint, Sprout has proven execution with revenues growing 43% last year and projected to stay above 30% annually for the next 3 years. Despite that early success, the company is still very small and unknown at $3 billion market cap and has pulled back close to 40% so far year to date. But we still see a massive market opportunity for the company with over 90 million businesses using social media today compared to that 30,000 customer base we talked about for Sprout.
Great. Thanks, Joe, for providing that color. I think we have time for one more question. And so we've already talked about performance of the portfolio over the last couple of years. We talked about why this time is different than the .com era, and then you provided us a couple of examples within the portfolio. Let's talk about more forward-looking now. Where does the strategy go from here? We're facing, pretty high levels of inflation right now. There's a lot of interest rate volatility. People are concerned about recession and growth. How might the portfolio benefit from certain secular growth themes that we could see down the road?
Sure. I think for better or worse, we've been here before and have been in periods of extreme underperformance. And historically, they've been followed by pretty dramatic snapbacks. Jamie Dimon's made a lot of headlines this year talking about the dark storms and hurricanes that we're going through and seas on the horizon. So we're fully aware that headlines will continue to be choppy. But the good news from our standpoint is that the weather changes, and ultimately fundamentals are the key driver to long-term stock performance. So economies, businesses, and just as importantly, investor psychology all naturally go through different cycles, ranging from exuberance to despair. We're certainly in the despair levels at this point. But meanwhile, innovation and technology advancements continue pressing forward to become more embedded and essential to everything that we do. So as is the case with Bill.com and Sprout that we just talked about, technology is solving key problems for businesses and for consumers. Automation and software continue to make businesses more efficient in a time of tight labor markets and challenging supply chains. Alternative energy and transportation electrification offerings from companies like Tesla and Enphase can offer offsets to that inflation and reliance on imported commodities. Artificial intelligence in the intersection that they're really working towards with our understanding of the human biology is offering very exciting new targeted therapies and research and diagnostic opportunities for companies like Viva Systems, Exact Sciences, and Repligen, another new name in the portfolio. So overall, really acknowledge that the path will have some bumps, but we're working hard and very excited to stay focused on company fundamentals and embrace this short-term volatility as an opportunity to invest in truly generational companies who are shaping the future of how we all live, work, and play.
Great. Thanks a lot, Joe. I really appreciate your time and spending a moment here talking about the portfolio and your thoughts on the market. I really appreciate it.
Great. Thank you, David.
To conclude, I wanted to bring up our disclosures page, and I wanted to let everyone know that our quarterly materials will be available within the next couple of weeks. And as most of you know, that's where we'll provide a deeper dive into our thoughts on the markets and the economy. Most of you also know that we're celebrating our 20th anniversary this year in 2022. So I really wanted to thank all of you for your relationship and really hope you enjoy this program and our webinars that we do. If you have any questions or comments, please do not hesitate to reach out to your engagement team at Altair. Otherwise, thank you very much for being with us today.